Good morning, everybody, and welcome to the session on wealth management. We have two stalwarts of the wealth management industry with me here, Apurva from Axis Bank and Somnath from ASK. Now, the way I was thinking about setting up the discussion, and the demand side of wealth management is actually fairly clear to everybody. The GDP, Indian GDP is growing at one of the fastest rates in the world. It's translating into a very high growth rate of HNIs and ultra HNIs. In fact, with the focus on financialization by the government and also the non-financial assets like real estate and gold being subdued in the last 10-15 years, there is also a larger part of HNI's portfolio going into financial assets. However, the financial advice or professional financial advice is still under-penetrated. So the way we look at is it's actually not, wealth management is not a demand side problem. I mean, there is enough demand, but it is a deep supply side problem, right? How do you really service this demand? How do you really deliver good quality financial advice and also make money from it, right? And I think that is what we would like to focus a little bit, talking with the participants today on the panel on thinking about the supply. How do we really get the supply right, and potentially in two parts. One is around the business models, what should be the business model, and how should the business models evolve so that we get higher penetration of financial advice with the clients, and also the product platform. How should it evolve? How has it evolved, etc. And within the product, we could, because it is, Yubi or Credit News conference, we could focus a little bit more deep dive on the debt platform and debt options that clients have today as they think about investing their portfolios. So with that sort of backdrop, so the focus on supply side, on business model and product platform, let me start maybe Somnath with you. Just kind of your comments on the industry in general, but specifically on how you have seen the business models evolve in your stint in the last 20 years.
Thanks, Atul. You're absolutely right. We don't have that big of a demand side problem in this industry, in wealth management, as we do of a supply side. And supply side very tightly ingrained into changing regulations as well, which sometimes structurally change the dynamics of how you deliver advice and how you deliver products. And how the biggest challenge is on the supply side, not just delivering the advice and the products, but delivering it at a revenue multiple that makes sense, that makes the business viable in the first place. On top of it, the big challenge that has come, and that is especially true for the predominant asset class that a lot of wealth manager conversations at least focus on, which is equities, has been the diminishing or the fast diminishing alpha that we have seen in the listed equities space. And it ties up with the challenges of delivering the advice and products at a margin that is profitable. Because as alpha diminishes, the squeeze on margins also go up, because the justification for margins is essentially the fact that somebody's advice and somebody's portfolio actions can generate a meaningful outperformance over the benchmark, which an investor can easily replicate by buying an index fund. And I think that, along with a very sharp pivot in regulatory environment that has started from 2008 and honestly has not taken a pause since then. And every couple of years we have new rounds of regulatory changes and interventions that business models have to adjust to. Now, those form the biggest challenge around the industry per se. A couple of years back, or maybe 3 or 4 years back, the big challenge that seemed to stare everyone in the face was robo-advisory, digital, and all that. For better or for worse, that threat has, or that opportunity or threat has seemingly died down. It seemed to be more of hype than what happened in reality. Uh, Not at the back end enabling front, but at a front end delivery front. But the bigger challenges remain in terms of regulatory pivots and the fast diminishing alpha across asset classes, which then asks tougher questions of wealth managers, of asset managers, to justify the margins that they are charging.
Yeah. Thanks, Somnath. So, Apurva, I mean, maybe to you as well, the same question that, just in terms of business model, how the journey has been and what do you think is the way forward where the industry is going?
Thanks, Atul. I think Somnath covered a fair bit of ground when he talked about some of the recent changes, including the parts that he covered on pertaining to regulation. I've seen significant evolution in the business over the last now almost 2.5 decades that I've been a part of the industry. And I think we've convincingly moved away from the one size fits all or the one asset class fits all portfolios model now to, I think, an era of hyper personalization. And I think it's a step in the right direction because quite clearly client needs are very diverse, and which means that anyone who is engaged in the business of wealth management will now need to take a very client-centric approach to devising solutions, for clients. I also feel that our approach to portfolio construction and asset allocation, of course, has changed significantly over the last several years. I mean, we talk a lot more about risk management now than what we used to earlier. And I again think that's a step, that's a very positive step. We've also created very client-friendly business models. I mean, unlike earlier where, there was no differentiation between the informed and the uninformed set of clients or, the large and the small set of clients. Today, we have very client-friendly models available. Technology has been a big disruptor, of course. And I think it's coming in with perhaps even more vigor now as we evolve. Clearly it's the learning curve. So I think as we embrace technology, the manner in which we adapt to it and the manner in which we implement it, I think that's clearly changing. And finally, I think we've seen the evolution of more efficient and innovative products over the last several years. And there used to be a time when I used to wonder, saying that there is a fair bit of commoditization as far as products are concerned. They tend to be very generic. But today, I stand corrected because there are several minute changes which were introduced earlier, which today have essentially led to those differentiated products diverging and creating different categories of themselves. So I feel that yes, on the demand side, as you rightly mentioned, we are seeing a burgeoning population of ultra high net worth clients in the country. I mean, whichever report you see, it talks about how the number of dollar millionaires in India is only increasing steadily and is expected to go up significantly over the next few years. I think on the supply side, the onus is clearly on us to make sure that we keep sharpening the axe, make sure that we stay ahead of the curve and are in a position to give cutting edge solutions to our clients. So let me just stop here, but I think that's a great way to start off our discussion. Thank you.
And Apurva, just following up on that, so another kind of the way wealth management industry in India is, it's also split between bank and non-bank players, right? So it's good that you're representing the bank model, and Somnath and me as well, come from the non-bank part. So just from a bank perspective, delivering wealth management through a bank platform, do you see advantages, disadvantages, at balance? Who has the upper hand?
Yeah, it's a bit of a subjective question, really. If you ask me, I've worked with banks throughout my career, and I think there are clear advantages that I see. I think there is and perhaps we might agree to disagree on this, considering Somnath and you are on the other side of the fence. But I think the solutioning tends to be very different. We tend to cover wider set of solutions that clients look for. I was asked on another panel some time back, saying that what is the difference between private banking and wealth management? And I said, well, by definition, wealth management looks at only the asset side of the client's balance sheet. And private banking, again, by definition, covers the entire balance sheet. So there are the odd occasions, and we've probably not seen this in India because we've conventionally had very, very high interest rates. But the extent of leverage which clients have adapted in other countries and other geographies tends to be much higher as compared to what clients have done here. But notwithstanding the last few months, we've also been in an era of falling interest rates. Clearly, the last couple of months have shown otherwise, but hopefully it will just be a small blip, in an otherwise downward sloping graph. I think as leverage becomes more and more acceptable as people start adapting to leverage, the ability of a bank to come in and provide leverage tends to increase, and leverage can be used in whichever shape and form. I mean, it may not necessarily be to acquire only financial assets; it could be to acquire real assets as well. Again, the advantage of being a bank is that we tend to have a larger bird's eye view on the client's finances. In most instances, we tend to be the primary banker for our client, which also, in a way, facilitates us to become the primary wealth manager for our clients. So that is a bit of an advantage. Surely, two sides to a coin. So clearly, there are limitations. Obviously, regulatory impacts tend to be much, much higher. There are a clear set of do's and don'ts which we have to abide by. But I think it's in the right spirit. So again, let me take a bit of a pause here.
No, absolutely. I think there are tremendous advantages in looking at the assets and the liability side of the client, and that too holistically, not just the securities assets, but also all kind of assets. But again, in my experience, the holy grail is, can you really bring all businesses together to serve the client seamlessly? And that again, back to our question of supply side problem. That it's the problem is. Can we really sort of have that all work together? And I think a bank that can actually make all of it work together seamlessly is unbeatable, right? Or will be unbeatable. So, Somnath, I mean, how would you sort of, let's say, counter that and say that, why do we, why do we exist if the banks have the distribution and the capability? Then why do we exist as an independent wealth managers?
Sure, it's a good point, fair point, and having been a banker most of my life before being a non-banker, what Apurva mentioned in terms of the ability of the bank to take a 360-degree view of clients' portfolio, both on the asset as well as the liability side, is a very, very distinct value add. But I think where non-banks kind of have their niche is in the fact precisely that they are not a 360-degree player in terms of their businesses. Banks tend to evolve into large institutions with several businesses, and in technical terms, some of them are sell side, some of them are buy side, and all of them have inherent structural conflicts against each other at various points in time. And good institutions, of course, set up rules, Chinese walls, and all of that to try and mitigate some of the impact of those evident conflicts. But they are all human dependent, finally, partly system oriented, but a lot of it is human dependent, judgment dependent. And like everything else, systems can also fail, and human beings and their judgments can also falter at times. So independent wealth houses have the advantage of being structurally non-conflicted. So to that extent, it becomes a service provider who doesn't have to grapple with a whole lot of conflicts in order to bring that supply side solution to the customer. And a lot of the lack of flexibility that generally banks have been known to bring, and as you said, if the bank could seamlessly provide the entire gamut of services that it has, then it would be unbeatable. But very often banks struggle to do that. The reason is not because people working in the banks, they don't want to do it, but it's just that in order to take care of the inherent conflicts in the various competing parts of the business, the processes themselves become quite cumbersome and clunky. And it actually then starts having second and third order impact on primary services that probably the bank is providing, or a tertiary service like a wealth management or wealth advisory business that the bank is providing. Now, an independent wealth management house, on the other hand, doesn't need to bother about that. So it can basically gear the institution to deliver that one thing that it is doing really seamlessly, really efficiently. And I think that's the raison d'etre of the independent wealth house.
Yeah.
So on a lighter note, I was quite clear we will not come to a consensus. So let's agree to disagree on this one.
No,
absolutely. And honestly, there's no right or wrong answer.
Absolutely. I completely agree on that.
It is, yeah. It's a bit like, who's the better batsman, Virendra Sehwag or Sachin Tendulkar? I mean, I won't get into who's Virendra Sehwag in this case.
Super
Vishwa Pujara or Virat Kohli, I mean, both have their roles to play and very different. But yeah, very interesting. I mean, in early days, we used to say that as an independent wealth manager, our strategy and hope is that a bank like SBI will never be able to pull it together, right? Because if they did, then there is no need for anybody else to really do anything. So that conflict continues, but there is a little bit of sort of the in terms of business model. I always think that banks generally do very well as a platform business, and as an advice business, a lot of the independent wealth players, because they don't have platform to kind of rely on, so they have to go and build sort of advice a little bit more deeply than banks. But absolutely both have. And if you really look at the league tables today, I think it'll be probably 80-20. 80% will still be with the banks, and 20% will be with the independent wealth providers. I mean, again, another question around business model. It's much sort of beaten down, but I'll sort of ask anyway, both of you, sort of this advisory versus distribution. So again, what are your thoughts there? I know the regulatory sort of challenges make it very complex to deliver advice which is in interest of client. But how are we dealing with the supply side challenge posed by these two types of offerings? Maybe Somnath, you can start.
Sure. So I think it's been one of the biggest learning curves. This whole advisory regime in India started sometime in 2012-13, and it's kind of gone on since then. Every few years, we've had a tweak or a pivot on how the entire regime is implemented. And that's where some of the bigger challenges around commercial viability versus regulatory, compliance, though that toss-up becomes the most tricky and extreme in this kind of a model. But I think it's a process of letting the market, which means both the supply side as well as the demand side, settle down to this for a period of time. Because it's only over a period of time that the supply side can demonstrate the value of its advice truly. And it's also over a period of time that the demand side will realize that there is a price for every service, and that includes advisory for investments and wealth management. And it's only then that we can probably see a better glide path towards how big this can potentially be. As of now, my sense is that this is perhaps a lot more geared towards the segment which probably needs it a little less, which is the absolute top end, the ultra HNIs, people with several millions of dollars, if not tens of millions of dollars of wealth to manage. And advisory probably makes sense for that tip. But that's also the level where the customers are probably the most sophisticated. They have their own resources. In many cases, they also have their own family offices, which are sort of doing a second layer of check over the various wealth managers, asset managers are advising, and hence probably a little less vulnerable. On the other side, for the smaller tickets, where probably the customer is a little less sophisticated and certainly has a lot less resources at his disposal, given that all of them have their own day jobs as well, to sift through the various complexities of investments, to be able to make the right decision by himself. And that's where it is probably most unprofitable commercially to deliver the advice. So we have a little bit of a forked cleaver here, which is the segment where it is most needed is probably not commercially viable. On the other hand, where it's commercially viable is probably less vulnerable from a risk and regulatory perspective. I don't see a straightaway quick answer to that. As I said, I think my sense is we'll have to give it a few years for the system to settle down, regulators, supply side, demand side, before a proper model on this evolves. Till then, like many other things that are uniquely Indian, it will be a 50-50, muddle through kind of process.
Yeah, very interesting, because again, this causes a lot of anxiety even let's say a provider like us, where you providing advice, but are you being true to the compliance? And what you're saying is that you have to dial down that anxiety because there is just no straight answer, and let the market evolve, probably do both, and then see where I mean, in this case particularly, the demand side is not ready, even though at a broader financial advice piece available, the demand side is very large, but people who are ready to pay for advice, the demand side is still evolving.
Yeah.
So that's a very interesting point, to be comfortable with the ambiguity that there is, and still do right by the client, continue to do right by the client. That's all we can do. Apurva, any thoughts on that from your perspective?
I think Somnath covered again a fair bit of ground on this one. Just a couple of points, maybe to kind of augment what he said. I think two things have evolved. A is that if you look at the whole wealth pyramid in the country, I think the bottom part of the pyramid, where you have a very large mass affluent, rather emerging affluent space, there are fair bit of DIYs over there. A lot of investors there are kind of wanting to try out things on their own. We've of course seen the large number of DP accounts which have got opened over the last few years. We've seen fair bit of volumes coming in from retail. There was a time when I think retail investors were largely being ignored by equity markets in particular. Today, we've seen a huge comeback, whether it is in terms of mutual fund SIPs, and we have data available in terms of what percentage of the business is coming in through direct and what is coming through regular and all of that. So I think there is a huge DIY space in the bottom of the pyramid, and top of the pyramid, as Somnath also mentioned. I think there are resources. There is obviously a very high level of cost sensitivity. So there, again, there is a lot of gravitation to direct. Needless to say, it's bound to happen because you tend to see much larger values being managed. That leaves the middle of the pyramid, and I think that middle of the pyramid is the pyramid where is that part of the pyramid where I think you have evolved clients. A lot of these people know that there are divergent models available, but honestly, it has to be their prerogative in terms of what they choose. So today, to my mind, I think what we can do as wealth managers is to clearly inform clients that, look, you have both options available. The question is, what would you want to choose? And I think, to my mind, this is a sound approach, because this allows the client to make an informed decision where, as a wealth manager, you can kind of put, various ideas there on the table and let the client take, let's say, focused and a very fairly independent call. So I think both models will coexist. Again, as I think Somnath mentioned, we are still a work in progress. Maybe over a period of time, you will start seeing a clear trend emerging. There will be a divergence in terms of which segment will gravitate to which model. I think we are probably still finding our way there.
Yeah, excellent. That's a good thought. So now maybe switching gears a little bit on the products, right? So, I always believe that, the value of advice, because we are all kind of trying to monetize, that's what we are delivering. Value of advice is directly proportional to maybe the complexity, right? If the commoditized platform becomes a little bit more complex, then I think the selection that an advisor can do is far more valuable. So, I guess we have a fair bit of complexity increase in the last few years. But what do you think about that? Is the product basket? Maybe complexity is the wrong term, but let's say the diversity of the product basket, separating the good from the bad, or at least giving you tools that you can do proper asset allocation. It's not one trick pony in any asset class. Has that kind of, have we moved along substantially? Is there room to go, or where are we heading there? Somnath, maybe you can start.
No, sure. I think a few years, till about maybe a few years back, there was a great deal of premium on the what you call the diversity of the product basket, but very often it boiled down to the sexiness of the product itself. The sexier the product,
complexity for the sake of complexity.
That's correct. And how frequently you come up with such new and sexy ideas that determined in some way your creds quotient, your credibility quotient of being a high quality manager. And India, like in many other walks of life, generally has a reasonable amount of acceptance, quick acceptance of new ideas. So customers, at least when they started, they picked up these things quite quickly. But I think it's sort of changed over the last maybe half a decade to a decade. wherein people are a lot more cognizant of the risks, especially the tail risks of many of these products and structures. We have seen a significant round of credit blowout in India. Thankfully, nothing compared to Lehman, but with DHFL, with ILNFS, we've seen significant pockets of credit blowout in India. We've also seen significant cycles or market cycles being getting a lot shorter on the listed equities side. And over the last year or so, we've also seen investors get used to a significant change of fortunes on the unlisted side, which had suddenly become a lot more exciting for a whole range of investors in the last few years. So I think the next few years, we will see a trend towards more simplification, more simplification at the front end, which very often would require a lot more complexity to be handled at the back end. A lot more focus on risk management and a lot more focus on on the right advice and the right um, risk reward equation being presented to the client. The days of telling clients that, listen, this is a great idea, you can get 25% returns on this for the next 5 years because there's a big amount of exposure to listed equity side. I think those days are gone because clients have seen it's been, you know, 30 plus years post reforms. We are in the third decade of the 21st century, and we've seen enough record in the markets to know what realistic return expectations are and what could be potential risks to generate that level of returns and to make more than that level of returns. And the next few years would be a lot more about adding value on risk optimization, on maintaining portfolios at lesser volatility and lesser drawdowns compared to trying to hit a seven bagger, 10 bagger. That sounds nice in conversations over a drink, but when you put it in an actual portfolio, the tail risks of them are much higher.
Yeah. So what you're saying is that rather than product innovation, more focus on process innovation. So, simplifying portfolio construction, the right asset allocation, a lot of that work done seamlessly and delivering to the client, not just kind of done in the back rooms of investment houses or wealth managers, but actually reaching the client in a seamless manner. Yeah, no, I agree. Apurva, thoughts on that?
No, I do agree that I think we are now moving from an era of complexity to now an era of simplification. I think the last few years have taught us that. And to my mind, I think every time we come out of a crisis, there are certain learnings which tend to stay with us. I remember back when technology stocks were ruling the roost. I'm talking about the early part of the millennium, where honestly, technology looked like the best thing ever, and so much flows were getting polarized into the so-called TMT set of stocks. When the crash happened, people realized the risks of concentrating portfolios across just a limited number of sectors. And I think then the whole concept of diversification started picking up. Back when we saw this big rush in the later part, in the tail end of the first decade of the millennium, we saw this huge gravitation towards infra, right? And people started looking at that as a big theme. And I think after we saw the global financial crisis, people realized that you cannot have a portfolio which is entirely thematic in nature. You need to have a bit of a core and satellite approach. You will need to at best take a bit of a tactical call on ideas like these. Look at more specifically, and I think Somnath alluded to this. Look at what has happened on fixed income in the last few years. It's actually I'm surprised, but I think the realization that fixed income is actually a binary asset class is something which people learned really the hard way. Because we've had several such instances, and I think Somnath alluded to a few of these great events, which have kind of in a way scarred people for life, because they've realized that look, fixed income, gone is the whole notion that it's probably the most predictable asset class. And I do realize that within fixed income in particular, people will now need to start prioritizing credit risk above every other kind of risk. Now, which clearly has led to the realization that complex is not necessarily good. You need to now look at a very, very high level of predictability. in the portfolio. And when I say predictability, I'm not talking about predictability in terms of the overall returns. Predictability is essentially in terms of the risk that you take, what kind of volatility that you will experience. And so now I made this point about risk management, and I made this mention earlier on that I think risk is clearly going to be at the forefront of what we do. And to my mind, the more complex the product, the more I mean, the risk becomes like it becomes like an iceberg. A complex product typically tends to show a limited amount of risk above the surface, but we know for a fact that there is a huge component of risk below the surface, which may not be very easily visible. So, bottom line, clearly, Atul, is the fact that I think we need to look at a trend of simplification. And complex at best can be some bit of a tactical allocation. I mean, I remember having conversations with second generations of clients, where they were saying that, look, why don't you ask us to invest into crypto? And I told him, I mean, I remember having these conversations where I told them, I said, look, we don't have a view on crypto. I mean, and at that point in time, we were sounding very naive. Today, perhaps we stand vindicated because, that was something on which we never really stuck our neck out. So the point I'm trying to make is that I think, the trend clearly is going towards simplification, and complex is not necessarily good. Let me rest my case here.
Yeah. Yeah. Especially, the last part of our conversation around more fixed income. I mean, you're right that at some point people realize that actually credit is a separate asset class. It's not same as fixed income. And you're taking completely different risk. You're not taking interest rate risk, but you're taking credit risk. And how to price that, how to assess that is a completely different ballgame. In fact, what is the right vehicle to take credit risk was also not known. And of course, thousands of crores of money got put at risk for managing credit risk in mutual fund format, right? I mean, in a daily liquidity product, how do you really manage a credit risk type product? So, and a lot of that obviously led investors through a lot of pain. But now, I guess on that, just focusing on debt for a minute and where all this was done in a mutual fund now, I guess that market has fairly opened up as well, right? I mean, not necessarily complexity, but I would say, again, diversity, different sort of options available in different formats, etc. That must be good for clients, right? I guess who are ready to take the right risk with their eyes open, right? Because some risk needs to be taken if you really need to deliver anything higher than the risk-free returns, right? So again, maybe on just talking about the credit spectrum, because that's again our sponsor or the platform that we are on. So Apurva, again, just on that, how you think things have evolved and where it's going.
No, actually, fixed income, obviously, especially the segment in which we work, is a very dominant asset class because people want a high level of predictability, high level of capital protection in their portfolios. So I think that's where we spend a fair bit of our time. Like I mentioned, I think there have been a series of events in the last few years which has kind of made us rethink the whole strategy on fixed income. Fortunately, and this is not propaganda, but as a house, we've always been very, very cautious, very conservative on credit. So I think fortunately, we didn't really get impacted when the whole credit crisis happened. But I think the learnings from that crisis are what we've taken into our approach. I'll give you an example, Atul, and between Somnath and you've been in the industry for such a long time. I'm sure you'll be able to relate to this. Conventionally, the space in which we operate, clients don't prefer to get regular cash flows, right? Because then that tends to build a bit of a reinvestment risk, which is why investment products within fixed income like FMPs and marketing debentures were typically more in vogue because in a way you were kind of kicking the can down the road and you were kind of saying that, okay, well, guess what, 3 years later or 2 years later, depending upon whether the idea was an FMP or a marketing debenture, I'll get a lump sum rather than kind of worrying about quarterly cash flows coming in. But today, I think a lot of clients have realized that these quarterly cash flows or half-yearly cash flows, depending upon what kind of construct is there to the product, is actually a very good thing because it gives you a quick check, right? A quick health check on the underlying investment. So, honestly, the reinvestment risk which comes in as a consequence of these periodic cash flows is actually a little less of a problem. But the comfort or the satisfaction of knowing that, your debt is being serviced on a fairly regular basis, right? There is a high level of predictability. I think that is something which has come out quite well. So today, I think to me, as somebody who will, we're managing a portfolio for large set of clients who want a higher level of predictability and capital protection in the portfolio. I would prioritize regular cash flows vis-a-vis the frame of mind that we used to be in earlier, where we would kind of prefer to have these bullet payments coming in on maturity. So that's been maybe a bit of a sea change in terms of the whole thought process. The other thought is, and I think you also made this great point about the fact that credit should be looked at as a separate asset class. And well, so I agree, so should it be. But the fact of the matter is that if you have to generate a spread over the risk-free rate, then you will have to create a debt portfolio which will have a blend. Today ideas like venture debt, structured credit. I mean, there is space in each client's portfolio. The percentages obviously have to be decided mutually. You cannot go with a one-size-fits-all approach again and say that, okay, well, guess what? For me, because I'm seeing, let's say, low double-digit returns coming out of some of these products, then I will prioritize these who are conventional fixed income avenues. I don't think that's the right approach. What is relevant is that you, within the debt part, also create a strategic and a tactical allocation, and there you try and kind of build in ideas which can, with a certainly, with maybe, of course, a calibrated level of risk, help you improve the overall performance on that part of the portfolio.
Yeah, no, excellent. I mean, not sell venture debt as a product, but as an allocation in an overall broad portfolio, not in isolation, because you need a mix of all. You need the best of AAA papers as well, even if they are giving you 3%. And then, you need some high yielding as well, as long as you control their exposure in a context of a portfolio. So, thank you. Somnath, your thoughts on the whole credit?
No, I think absolutely spot on. From an allocation perspective, the asset allocation approach has to be taken. The other important lesson out of the last few years of credit blowouts around are twofold. One is taking portfolio approaches always work a lot better than taking individual security approaches to investing. So if somebody were to have a chunk of his portfolio invested in a single DHFL paper, he would feel the pain a lot more than if that DHFL was 5 or 10% of a larger portfolio that he had invested as a credit risk portfolio. Second, more important, I mean, that's more, sort of the service delivery aspect of it. But more importantly, the evaluation and analysis of credit has undergone a radical, or has had to undergone a radical change. What was taken up as a credit rating meter, so anything that is AAA or AA plus, automatically is good and therefore safe. That whole presumption of safety has had to be relooked at. There are several AAAs that we have seen who have overnight gone from being AAA to nothing at all, and there are several, couple of AA pluses as well that have had the same fate. So evaluation of credit has become a lot more sophisticated, or has had to become a lot more sophisticated, has had to become an area where a lot more value needs to be added, rather than simply looking up the credit rating and at best pick up the ratings rationale and say, okay, this is fine. And that's where the ability of people like us, wealth managers, to add value to portfolios come in. And that's the whole raison d'etre of our existence. As you said, it has to have an allocation. Otherwise, there's not going to be that inflation beating performance in place. And if you have to be there, then you might as well select in the right fashion. And that's where I think it's a great opportunity for wealth managers to really add value.
Yeah, and wealth managers as well as the right partners. And I think there I must say that now with the advent of, let's say, a firm like Vivriti Capital, where actually truly 45 credit analysts are focused on assessing credit of companies, gives us a lot of comfort to rely on, versus mutual fund companies that were managing 25-30,000 crores, but with two credit analysts sitting in Mumbai. So I think our work, but also the right partners collectively, but the focus on credit analysis is absolutely critical to deliver the right alpha in the client portfolios. So thanks a lot, Somnath. Apurva, I mean, our time is coming to an end. I see the clock ticking down to zero. But it's been a great conversation. I think I have had a lot to learn from both of you, and what you mentioned tones down my anxiety about some of the issues I face as well. So I hope our audience found it useful as well. Thanks a lot.
Thank you. Thanks for
Pleasure being
thanks
here.
for having me.
Thank you.
Bye bye.